Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. on Tuesday, May 16th, 2023. And welcome back to the Crypto Overnighter, where we have no sponsors, no agenda, and no BS. The crypto industry was significantly affected by the bank runs of 2022. The collapse of several major players in the ecosystem triggered these runs. A recent Federal Reserve Bank of Chicago study highlighted the principal elements and triggers that intensified the crypto crisis. Large withdrawals by major crypto holders and institutional accounts on centralized exchanges were identified as the critical factors. This led to a liquidity crisis, and that crisis ultimately resulted in the bank run. The first major issue was the collapse of Terra. This event led to a significant number of customers withdrawing their funds from crypto lenders associated with the ecosystem. In the 11 days following Terra's collapse, Celsius and Voyager Digital experienced 20% and 14% customer fund outflows. Now, it's worth noting that Celsius had previously invested nearly $1 billion in Terra's algorithmic stablecoin, which ultimately failed. The second significant event was the downfall of Three Arrows Capital in July of 2022. High customer outflows also marked this event. Celsius and Voyager Digital experienced another round of outflows, this time 10 and 39% respectively, due to their exposure to the now bankrupt 3AC. Now, 3AC's failure had a ripple effect throughout the crypto industry. Several firms invested billions in crypto assets in the hedge fund. Genesis Capital had provided loans to 3AC totaling around $2.4 billion. BlockFi, and we'll be talking about them in a bit here, they provided $1 billion. Voyager Digital provided $350 million and 15,250 Bitcoin. Celsius provided around $75 million. So when 3AC failed, that led to a significant crisis. Now, the third significant event was the collapse of FTX in November of 2022. News of this financial instability led to over 37% of customer funds being withdrawn from the crypto exchange. Following FTX's downfall, Genesis and BlockFi customers withdrew around 21 and 12% of their investments. While these failed crypto platforms had a large retail customer base, the withdrawal of funds by institutional clients led to a major crisis. Before June 9, 2022, several institutional clients had contributed funding of $1.9 to $2 billion to Celsius. Owners of large accounts with investments over $500,000 withdrew funds at the fastest rates and proportionately more quickly than other account holders. For instance, account holders with more than $1 million in investments made up 35% of all withdrawals at Celsius. The FBRC's research report showed that while large customer withdrawals did accelerate the crisis, the real issue was the high-risk investments offered by crypto lending platforms. Unlike traditional banks, these platforms offered no security or insurance against failures, which led to widespread customer panic. Now, all right, folks, buckle up because I don't understand their logic at all. Now, I don't know about you, but I've been watching this whole Silvergate, Silicon Valley Bank, Signature, First Republic debacle unfold like a slow-motion train wreck. These banks were supposed to be the pillars of our financial community. They were sacrificed. They were left out in the cold, and they were left out in the cold by the very institution that's supposed to have their back. Why? Because they had the audacity to be friendly with crypto. You heard me. They dared to embrace innovation, to look to the future, and for that, they were left to crumble. And now the government, in all its infinite wisdom, had a golden opportunity to step in and save the day. They had this shiny new fund just sitting there waiting to be used. But did they use it to save Signature and First Republic? No, they did not. Instead, they chose to sacrifice those banks on the altar of their anti-crypto agenda. And let's not forget about the collateral damage here. We're talking about families, businesses, people who had nothing to do with crypto, who are now left picking up the pieces. It's like watching a surgeon perform a heart transplant with a chainsaw. It's messy, it's unnecessary, and the patient is left in worse shape than before. So here's a thought. How about next time, instead of playing political games with people's livelihoods, you just do your job and protect our financial institutions? But hey, that's just what I think. The U.S. Securities and Exchange Commission has recently challenged Coinbase's assertion that the digital asset industry requires a new regulatory framework. The SEC has urged an appeals court to dismiss Coinbase's plea for more specific regulatory guidance tailored to the digital asset industry. Gosh, why would they want that? In an escalating legal battle, Coinbase submitted a mandamus petition to the U.S. Court of Appeals for the Third Circuit last month. This petition sought to compel the SEC to respond to their initial request. Coinbase initially filed this petition with the SEC in July of 2022, so it's been a while. However, the SEC has yet to decide on the petition. It has stated that it is still considering the filing. The regulatory body has received over 1,600 comments on the matter, with Coinbase contributing 3 of those comments. The SEC has also pointed out that the process of considering new rules or amendments to existing regulations does not prevent it from enforcing the current regulations. This statement came in response to Coinbase's expectation of a reply within less than a year, while the SEC has taken up to 5 or 10 years to respond to petitions in the past. The SEC's stance on the matter has sparked a debate on the need for regulatory clarity in the rapidly evolving digital asset industry. As the industry grows and innovates, this need for clear and effective regulation becomes increasingly important. This ongoing dispute between Coinbase and the SEC serves as a reminder of the complexities and challenges involved in regulating this new and dynamic industry. Gensler, the chair of the SEC, recently voiced his concerns about the state of the crypto markets. He believes these markets are generally non-compliant and are based on a false decentralization narrative. His views were shared during a Q&A session at the 27th Annual Financial Markets Conference hosted by the Federal Reserve Bank of Atlanta. Gensler said that his main concern lies in the belief that the crypto markets are built on a false decentralization narrative. He argues that the most decentralized platforms or protocols are in fact centralized around a few operators in some way. This raises questions about the transparency and the fairness of these platforms, which are vital aspects of any well-regulated financial market. The SEC's dispute with Coinbase was also discussed at the conference. Now, the SEC served Coinbase with a Wells notice, probably based on the suspicion that Coinbase may be marketing unregistered securities, or at least that's what they'll tell you. Now, in response, Coinbase sued the agency in an attempt to force it to create new rules for the crypto industry, which is the genesis of this whole thing. Now, Gensler emphasized the need for compliance in the crypto industry. He stated that the SEC's rules about what it means to be an exchange, a broker-dealer, an advisor of custody and assets, and how to register a securities offering are already in existence. He added that nothing about new technology makes it inconsistent with the public policies that Congress has already laid out. Gensler also noted that the increasing interconnection between traditional finance and crypto exists. He pointed out that 3 of the 4 recent bank failures in the US had significant crypto books. In fact, we were just talking about them. Now, this was intended to underline the notion that the more interconnected the worlds of traditional finance and crypto become, the more likely that it might be for the financial market fires to get started. The future of crypto regulation remains uncertain. However, Gensler's comments underline the need for greater compliance and regulation in the crypto markets. As the crypto industry continues to grow and evolve, it will be crucial for regulators to be able to keep pace and to be able to ensure that the markets operate fairly and transparently. Thank you so much for tuning in tonight. If you're enjoying the podcast, please give it a like, follow, maybe subscribe. That way, not only do you get notified of every episode when it comes out, it has the additional benefit of getting more attention to the show, which is always good. So, thank you. Now, if you've been listening to the show for a while now, you know my position. Crypto is horrible for criminals. Cash is king for crime, especially when it comes to hiding your crimes. Well, if you check out their latest AMA on Reddit, the US Secret Service would agree. Stick to cash. This piece of advice was part of a broader discussion during a Reddit Ask Me Anything session where the Secret Service and a California criminal task force shared their expertise on tackling crypto crimes. The session was hosted by the Secret Service's San Francisco Field Office and the Bay Area Regional Enforcement Allied Computer Team, or REACT. Their goal was to educate crypto users about the risks and realities of the crypto world. While cryptocurrencies might be the preferred medium for some criminals, the officials pointed out that the blockchain can be a valuable tool for tracking financial crimes. They said, quote, "The blockchain provides us with an amazing opportunity to track the flow of money." The discussion comes in the wake of a record-breaking year for crypto hacks. According to data from Chainalysis, 32 separate attacks occurred globally in the previous year, resulting in nearly $776 million being stolen. Now, most of these attacks targeted decentralized finance protocols. The Secret Service, known for protecting U.S. leaders, also safeguards the country's financial infrastructure. Their San Francisco office has a dedicated team of special agents and analysts focusing on crypto crimes. For these agents, understanding the intricacies of Bitcoin is crucial, with the Bitcoin white paper being a mandatory read for new recruits. REACT is a task force comprised of local detectives and their federal partners. It was established by the California legislature in the late 1990s to tackle high-tech crimes. And lately they've been focusing on pig butchering crypto thefts. Now that's a scam where the perpetrator gains the victim's trust before stealing their crypto. The team has successfully recovered millions of dollars in stolen funds and then returned them to the victims. They proudly stated, "We can and do recover funds and return them to victims." Despite the advancements in monitoring crypto transactions, the Secret Service acknowledged that the volume of money laundering in crypto is still less than it is in fiat currency. Now, that information comes to us from a U.S. Treasury Department report. Locating victims of crypto crimes and recovering their funds can be challenging. The Secret Service shared an instance where they found a victim on Reddit who had posted about an investment scam but had not reported it through the official channels like the Internet Crime Complaint Center. They emphasized the importance of reporting, saying every case is different, but no hope if you don't report. It seems like they were kind of having fun with this too. The session could have been more serious. Some Redditors asked lighthearted questions like whether law enforcement could track transactions on Monero. Now, Monero is a privacy-focused cryptocurrency. The Secret Service responded with a playful, "Call me." Another Redditor asked if the Secret Service had considered releasing a token or a meme coin. In response, the Secret Service mentioned the NFT collection they created and minted last year. It features agents in San Francisco locations like Alcatraz and Chinatown. And before they left, they signed off as Mr. Secret. The European Union has taken a monumental step forward in the world of cryptocurrency by approving the Markets in Crypto Assets Regulation. This unanimous decision by the EU's Council represents 27 member states. It makes the EU the first primary jurisdiction to establish a crypto licensing regime. This move is a big leap forward for the crypto industry and a significant stride towards ensuring investor security and the market's integrity. Under these new rules, crypto firms, including wallet providers and exchanges, will be required to seek a license to operate across the EU. This requirement extends to stablecoin issuers, who will now be obligated to hold suitable reserves. This measure aims to bring more transparency and accountability to the crypto market, protecting investors and preventing industry misuse for illicit activities such as money laundering. The EU's move to regulate the crypto asset sector responds to the urgent need to protect Europeans who have invested in these assets. The new regulations also include robust anti-money laundering measures. These measures are designed to prevent the misuse of the crypto industry for money laundering and financing terrorism. The new rules are expected to take effect a year after they're published in the EU's official journal. That's likely to happen in June or July. This gives firms ample time to understand the new regulations and to make necessary adjustments to their operations. The EU's decision to regulate the crypto market is a significant development that will likely influence how other jurisdictions approach this burgeoning industry. By setting a precedent for crypto regulation, the EU is leading the way in creating a safer and more transparent environment for crypto investors and firms alike. I wish we could get that here. The future of funds recovery for the clients and creditors of BlockFi is primarily tied to the company's claims against its business partners, FTX and Alameda. This information came to us in recent court documents. BlockFi's wind-down plan, submitted to the U.S. Bankruptcy Court for the District of New Jersey, suggests that the outcome of the legislation supporting these claims could have a significant impact. It could affect over $1 billion, which is a substantial amount that the clients are eagerly awaiting to get back. The plan included the liquidation of approximately $1.56 billion in claims. However, the actual recoveries may vary. BlockFi currently has about $355 million in crypto assets frozen on FTX. Additionally, there's another $671 million loaned to FTX's trading division. Both FTX and Alameda Research are also undergoing Chapter 11 wind-down procedures in Delaware. The liquidation plan filed on Friday allows for the total return of non-estate digital assets in client wallet accounts. However, this is subject to applicable deductions. In a recent ruling, a U.S. bankruptcy judge stated that BlockFi custodial wallet users could receive nearly $300 million in owed funds. The court has scheduled a hearing on the plan for June 20th. This hearing will be crucial in determining the future course of action and could bring some relief to the stakeholders involved. And finally, our cover story for tonight. Ledger is a prominent hardware crypto wallet provider. They recently introduced a recovery tool named Ledger Recover. It's designed to be a backup for users who lost their seed phrase. It splits the seed phrase into 3 parts, known as shards, and then sends those shards to third-party companies. When combined and decrypted, these shards can recreate the original seed phrase. However, this new feature has sparked controversy among crypto investors and security experts. Moody Gupta is the Chief Information Security Officer at Polygon Labs, and he voiced his concerns on Twitter, stating that the issue lies in not splitting the key, but the fact that these encrypted parts are sent to 3 corporations, which could then reconstruct the keys. This sentiment was echoed by other influential figures in the crypto community, including a crypto investor known as DC Investor. Now, DC advised their large Twitter following against upgrading to this firmware. On Reddit, Ledger users sought clarity on how this process works and whether the seed phrase information is sent directly from the wallet. In response, Nicholas Baca, he's the co-founder and VP at Innovation Lab at Ledger, he explained that the device sends encrypted shards of the seed to different companies if the user decides to use the service. He also reassured users that this doesn't change the security assumptions compared to a firmware update. Despite this, some users remained skeptical, expressing concerns about the potential for exploitation by bad actors. Ledger responded to these concerns by stating that the decryption of the 3 shards can only happen on the Ledger device after the user has proved their identity. The companies involved never have access to the seed phrase, and it's not stored in the cloud. The backups are only encrypted, fragmented, and decrypted directly on the Ledger if the user subscribes to the service. The Ledger Recovery service will cost $10 a month, and it will initially be available in the US, the UK, the European Union, and Canada, but they do have plans to expand to more countries. It will rely on 3 custodians, Ledger, CoinCover, and EscrowTech. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.